Picture this. On June 12th, we are looking at the biggest stock market debut in history. SpaceX is going public, and it's carrying the highest price tag any company has ever had on its first day of trading. Now, somewhere in those first few minutes, that price is absolutely going to jump. Millions of people are going to see that jump, they're going to feel this intense fear of missing out, and they'll take it as undeniable proof that they need to get in right now before it's too late. But before you let that instinct take over, we really need to take a calm, calculated step back. I'm Taylor Reed.
And the core question we are tackling today is this: should you buy the SpaceX IPO on day one? Welcome to Dollar Playbook.
Okay, let's dive right into this. Here is our roadmap for today's explainer. First, we'll look at the IPO hype machine. Then we'll look under the hood at the actual business and examine what I call the price tag problem. After that, we'll uncover the hidden relay race, break down the insider lockup trap, and finally, we'll do the math of patience. We're going to break this massive, complex machine down into simple, logical steps.
All right, Section 1, the IPO hype machine, and why you really shouldn't let opening day decide your financial moves.
You know, first-day excitement is often just noise. Take Rivian, for example. It popped early, but ultimately fell 67%. On the flip side, Reddit flopped on day one, but then climbed 150%. And this really illustrates a fundamental difference we need to grasp. By almost any measure, SpaceX is a genuinely great company. They're launching more rockets than entire nations, they're running a massive Starlink network across over 160 countries. But a great investment requires the right price and the right timing. A great company and a great investment at a given price on a given day, those are not the same thing. And let me tell you, the gap between those two realities is exactly where ordinary, everyday investors tend to lose their hard-earned money. Moving right along to Section 2, looking under the hood at the actual business. Let's peel back the surface hype for a second and look at the actual numbers they filed for 2025. Look at the breakdown of their $18.7 billion in revenue for the year. Now, it is absolutely a massive business, but overall, the company actually lost roughly $4.9 billion. While everyone immediately thinks of rockets, Starlink actually brings in 61% of the revenue. And here's the kicker. It's the only part of the company turning a real operational profit. It generated around $4.4 billion, while the other divisions are essentially burning cash. So when you buy in, you're basically buying one profitable engine doing all the heavy lifting, towing several heavy money-losing cars behind it. Which brings us perfectly to Section 3, the price tag problem. This is where we talk about paying for a story. Now, there's a totally reasonable case to be made that those other divisions will become incredibly valuable someday. But this IPO valuation, it's priced as if that future someday success is already fully guaranteed today. Just look at this valuation jump. Back in the middle of 2025, SpaceX was valued in a private sale at around $400 billion. The IPO valuation just months later, $1.75 trillion. Guys, that is a staggering 4.4 times jump in just 11 months. Did the business underneath magically quadruple in size during that time? Did they build 4 times as many satellites? No way. Revenue grew by about a third. The business didn't get 4 times bigger, only the story got 4 times more expensive. To put that $1.75 trillion price tag into practical everyday terms that you can judge for yourself, you are paying roughly $94 for every single dollar of revenue this company brings in. 94 to 1. And remember, this is for a business that is currently operating at an overall loss. For some context, large, established, profitable companies usually trade in the low single to low double digits on that measure. In fact, one of the most respected independent research firms on Wall Street ran their own detailed numbers, and they valued the company at roughly $780 billion. That is about 55% below the prices going public at, which means the entire run-up to that $1.75 trillion happened in the quiet window right before the public was finally invited in. Let's move to Section 4. The hidden relay race. Who actually gets the good seats? You see, there are actually 2 totally different prices involved in this IPO. There's the $135 IPO price, which is negotiated before trading even begins. That goes almost entirely to large institutions, big banks, and a very limited pool of insiders. Then there's the open market price. That's what you and I will likely pay when it starts trading on our apps, and it is almost always much higher. Now, Wall Street is steering a generous 30% of this offering toward everyday retail buyers. But be careful here. When Wall Street generously widens the door for everyday folks, it usually just means they are passing the risk to you. Because demand wildly outstrips supply, most people won't get anywhere near that $135 price, and they'll be forced to buy on the open market at whatever the popped-up price happens to be. This dynamic creates what we like to call the relay race. Think of it as a carefully engineered sequence where Wall Street insiders buy at the starting line at $135, and then they pass the baton, which in this case represents the risk, to latecomers who show up and buy high on the open market. So that day one pop everyone gets so excited about, it's not actually proof that the stock is a great investment. Mechanically speaking, it's just the sound of the baton changing hands. The people who bought low are simply securing their profits by selling to the people who showed up late to buy high.
Section 5. The Insider Lockup Trap and the Waves of Selling.
Let's trace this timeline after the debut because it is absolutely crucial. After the day one pop, there's a subtle rule change that can force a massive wave of automatic buying. Big index funds, the kind sitting inside millions of ordinary everyday retirement accounts, are often required to buy a newly public company once it qualifies, completely regardless of the price. This forced buying artificially props the stock price up in those first few days and weeks. But listen to me, that elevated price isn't a safety net protecting you. It actually acts as a launch ramp, pushing the price up just in time to create a very lucrative exit for early insiders. Those insiders are going to start releasing their shares by late summer, leading up to a massive release right at the 6-month mark. So, we really need to understand this phased lockup release. Obviously, insiders can't sell all their shares at once. That would flood the market on day one and collapse the price entirely. So instead of one single date, SpaceX has designed this tricky series of timed releases. The very first batch of shares hits the market just days after their first quarterly report, which will likely land in late summer. Then, multiple release waves open at intervals after that, finally culminating in a huge block at the standard 6-month mark. Now, yes, the founder has agreed to hold his own stake to a 1-year lockup. That sounds super reassuring, right? Until you realize that everyone else is absolutely not on that schedule. This complex, phased schedule perfectly times fresh supply entering the market exactly when the headlines move on, retail excitement fades, and that early demand drops. Fresh supply meets fading demand. And that combination is what reliably pushes the price right down.
Which brings us to our final section, number 6, the math of patience. Let's run the expectations test.
Let's just forget trying to guess or predict what the stock will do next month. Honestly, nobody knows that. Instead, let's quietly look at what SpaceX must actually achieve in the real business world just to be worth this astronomical price tag. Let's walk step by step through the 10-year expectation math. Step 1, we start at that $1.75 trillion price. Step 2, let's set the bar as low as possible and just ask what it takes to match doing the boring, lazy thing. Buying a basic index fund and getting around 10% a year for 10 years. Step 3, if you compound that, it means SpaceX must reach a required value of $4.5 trillion a decade from now. That is what's required, literally, just for you to break even on this bet against doing absolutely nothing. Now, to justify a $4.5 trillion valuation, assuming it trades as a very successful, mature blue-chip company by then, SpaceX would need to pull in an astonishing $566 billion in revenue. That's enough to make your head spin. It is roughly 30 times its current revenue. To hit that in 10 years, SpaceX requires an unprecedented 41% growth every single year for a decade straight, without stumbling once. Guys, that is faster, for longer, than almost any technology giant in history has ever managed in its best decade. You aren't just buying a great company at a fair price here. At this valuation, you are paying upfront for a near miracle. The market rewards the patient far more reliably than it rewards the early. Patience costs you absolutely nothing. You can simply wait a few months, let the forced index buying run its course, and let the price reflect reality rather than the hype. And it really leaves us with a critical question. If a historic juggernaut like SpaceX requires a near miracle just to justify its day one price tag, how much hidden risk is currently sitting inside the rest of your portfolio? Let me know your thoughts down in the comments. And as always, if you found this explainer helpful in managing your money with a level head, please like, share, and subscribe to Dollar Playbook so we can keep bringing you practical financial lessons you can actually use in everyday life. I'm Taylor Reed. Thank you so much for joining me, and I'll